Morning, everyone. I think the consumer's actually doing okay at the moment. I think the reporting season played out as we thought in that consumer didn't get any worse from April. In fact, trading conditions kind of improved, and I think that's more or less kind of continuing as we speak. So it's certainly not dire out there. I think the consumer just adjusts to the new norm and to changing conditions and move on. They take the high utility prices, still realise they're not doing too badly, and they start spending a little bit again. So that actually does play out. So the risk for me at the moment isn't around the consumer. Risk is clearly about Amazon, unfortunately, still. Whenever they come, if it's pre-Christmas, some people are saying, if it's post-Christmas, it doesn't really matter, as long as that we know they're coming kind of soon. Am I worried about them? Absolutely. I mean, 10 years down the track of them being in the US, when we had Best Buy down 10% 2 nights ago, last night Bed Bath & Beyond down 16%, some of the auto guys going down, so their impact is being felt more so 10 years on. So, I suspect once they hit, all of us retail analysts will be sitting there busily doing kind of product pricing match kind of surveys, very dull. But at least as soon as they're here, rather than trying to guess, we can start trying to gauge this kind of impact. But it will take years to play through. Interestingly, I think some of the good operators, like a JB Hi-Fi, even Super Retail Group, are starting to invest some of their ammunition into price now, so that by the time Amazon comes, the pricing differential first up probably might not be as stark as some people think, and maybe we actually see a bit of less caution in some of those stocks once they see the price differential isn't on any more than like 10%, which is what it needs to be, I think, to get a real flood of loss of share. So, look, the sector's undoubtedly still tough. We were firmly remain stock pickers and unashamedly, trying to keep to being fleet of foot with this really cyclical kind of sector. But there's still some good names out there, Matt.
And so with the AGM season around the corner, what are your top picks in your sector?
Yeah, so catalyst-wise into year-end, not just AGMs, there's a few there. So Domino's, interestingly, the AGM could be a bit ho-hum. I think the Australia-New Zealand business clearly will have slowed. Don has said that to the entire market repeatedly, but given the exceptional base they're cycling, so they're cycling around a 20% comp, which is hard to cycle. So the market might sit there with a 13% short interest and go, oh God, look at this, Australian business really slowing down, but there's reasons for that. But then Europe, I think, will go the other way and should be accelerating. So they may kind of offset each other. We certainly won't get an upgrade to guidance. That'll just be reiterated. There's also an investor day on the 9th of October. That'll be more around kind of a technology update. He did say there's some groundbreaking releases he's going to make. I'm not sure technology releases really move the dial PE-wise with this stock anymore, but it'll be news flow. So where I think the actual catalyst is with the acquisitions. Don said they're the most active they have been in some time, both in terms of more Domino's jurisdictions, bolt-ons potentially in Europe of pizza companies, and then potentially down the track something big outside of pizza. So, he was quite firm that they're very active there. So that's going to be helpful to EPS should they come to pass. The other one's Lovisa, their AGM. I think we'll get another really strong update there, to be frank. And given they're trading, they're cycling a 12% comp. If they come out with a similar kind of plus 5% number cycling that, I reckon the market will get pretty excited with that. The other thing, they're in global rollout phase. They did launch a business name in the US. If they come out at any time in the next 6 months and say, we've launched our first trial store in America, this thing's going higher. So there's still catalyst there. I put that back onto a hold too early, but a firm hold and buy on the dips. Adairs as well, I think you'll get another really strong trading update. There it has more than doubled off its lows. However, so I think that's a definite hold on. If their comps are traveling anywhere near where they have been, they'll lift the bottom end of their guidance. Maybe wait for Christmas to flow through to lift the top end of their guidance range. But anyway, I think my numbers will end up being maybe 10% too low, and therefore this thing's probably on about a 10 times PE, so you can at least hold on there. Bapcor, we're looking for asset sales. We've been saying that for 6 months, so is the company. I think they will happen in the next couple of months, at least 2 of them, that will allow the market to believe that they always wanted to sell these assets and get that gearing down, which is positive. And Motorcycle Holdings, pure and simple acquisitions, always been the name of the game, where the valuation and earnings upside is. Dave was in here. It's either going to be in accessories and or in dealerships. And as we know, they can be materially accretive. So that's the catalyst list
Okay. And you also mentioned motos as one of your top picks there. In the motor vehicle space, you also cover AP Eagers and Automotive Holdings. Automotive Holdings came in to present last week. Can you just comment on the vehicle market at the moment, what you're seeing with AP Eagers and Automotive Holdings, and maybe your preference, motos number one and the other two?
Yep. So the automotive market's tough. We've come off a couple of really strong years of growth, so it needed to have that moment of real slowdown, and we're seeing that come to pass. In terms of preference, probably motos number one. Although if you look at their current earnings versus the valuation, that's fairly valued, but we've got a lot of acquisition activity to catch up yet. And then I'd say AP Eagers and Automotive probably the same vein at the moment, although AHG has more short-term upside in my view, but AP Eagers is the better quality long-term play. So look, we're sitting there, we're holding on to AP Eagers, we're going to ride out the next 6 months, and then they're doing some really interesting stuff with their property and their cost base that will see them return to growth. So we're happy just to ride that one out. And AHG provides some really good leverage to this WA recovery. And that new CEO who came in for the first time, he's impressive. Martin Ward actually hired him back in his days at Inchcape, so he believes he's a good operator, and he's doing some good things with the cost base. And the market's screaming for leverage to this WA recovery outside of resources and the services companies, and I think this will eventually come to pass. And it's ex today 9 cents. It's nearly a 6% fully franked yield, 13 times, and some good WA leverage.
Joe, just a question on Domino's. You mentioned acquisitions 5 or 6 times in that presentation, but what's their balance sheet capacity? I mean, they're doing a 300 mil buyback. There's already a bit of debt there. How much scale can they actually buy?
Yeah, so if you fully factor in this buyback, I believe their net debt to EBITDA goes to around just over 2 times. Their parent in the US now, I think, has 5.5 times net debt to EBITDA, and said they're willing to go to 7. But anyway, that's too high, obviously. So look, a decent acquisition is going to definitely require a cap raise. If it's just another small bolt-on, they'll just take on the debt. I'm only factoring in them doing 150 mil of the buyback this year and another 150 next year, so I can have them, easily funding that. But just remember, they're getting the debt mostly out of Japan. They're paying nothing for that. It's, their interest cover ratio is 30-something times. I don't mind just commenting on Baby Bunting, if you wouldn't mind, just for a longer term play. We saw the number one competitor in Queensland, number one brand awareness brand called Bubs, go into receivership a few weeks ago. That is the clearest sign you can have that these guys are having extreme pressure or placing extreme pressure on their competitors. So that's about the third or fourth big chain that's now gone into receivership in this space. There's a couple of other smaller operators, Baby Co, who used to have 7 stores, now down to 1 as of yesterday. An Adelaide operator that's been around for 35 years now closed its doors because Baby Bunting opened 2 stores in the last 6 months. So they're becoming more and more a category killer. Yes, Amazon will have an impact at some point on this sector, but they're just getting all this other share from the other guys going out of business too. So I just think, they're in a really good competitive position. It's a good, strong category. Toys R Us have just gone into Chapter 11 in the US. Now, they own 85% of Toys R Us in Australia and Babies R Us. They've said it's business as usual, but surely if you're a supplier, you're sitting there going, I better be a bit careful here. You're looking at Baby Bunting with a net cash balance sheet. You know who you'd rather be dealing with. So, this is a bit of a year of investment. They will feel an impact when someone goes out of business on their short-term like-for-likes, but medium term, it just looks better and better. So for us, that's now up there. So I'd say Baby Bunting, still really like Bapcor, and Motorcycle Holdings are probably the top 3, but also really liking Lovisa and Domino's as well.